Silver returned 144% in 2025. Gold returned 65%. The S&P 500 didn't beat either of them. That was year 2. We are now in year 3. 3 consecutive years of precious metals outperforming the entire stock market, and almost no retail investor you know owns a single ounce. According to Goldco's January 2026 report, silver's 2025 performance was its best calendar year in over 4 decades. The Motley Fool ran a headline last week asking whether precious metals can outperform the S&P 500 for a 3rd straight year. They already are. There's a scoreboard flashing a result that almost nobody in your portfolio, your office, or your friend group has bothered to look at. And here's what makes this urgent. This kind of streak has only appeared twice before in modern history. Both times, the most explosive phase of the entire cycle came after the streak was already established. There are exactly 3 things that have ended every previous streak. I'll show you all 3, and whether any of them are present right now. My name is Alex, and I've spent the last decade tracking commodity cycles, central bank policy, and sovereign debt data so you don't have to. If you want to understand what's actually happening in markets beneath the headlines, make sure to hit that subscribe button and give this video a thumbs up if it helps you see something the mainstream is missing. Before we dive in, I want to know, do you own any physical metals, or is your portfolio 100% equities right now? Drop your answer in the comments, because I think the split in this audience is going to be fascinating. Here's the thesis of this video. I'm not going to tell you to buy silver. I'm not going to tell you to sell your stocks. What I am going to do is hand you a historical map. The same map that would have told you in 1972 and again in 2009 that precious metals were about to enter their most explosive phase. By the end of this video, you'll have everything you need to answer one question. If you hold 0 precious metals and 100% equities, does the data say you have a problem? Let me set the stage, because most people hear silver is beating the stock market, and their brain immediately files it under speculation. Crypto bros and gold bugs, right? That's the trap right there. Because what's happening in precious metals right now is not a speculative mania. It's a structural shift backed by supply data, central bank behavior, and sovereign debt math that hasn't looked like this since the 1970s. And the 1970s are exactly where we need to start. From 1970 to 1980, silver compounded at over 30% annually for a full decade. Not a lucky year, not a spiking crash, a decade of sustained outperformance that made equities look like a savings account. Then it happened again. After the 2008 financial crisis, silver rose over 500% from its 2008 low to its 2011 peak, 500% in roughly 3 years. Both of those cycles share something specific with today, and it's not what most people think. I'll show you the exact parallel in a moment. But first, you need to understand why the conventional wisdom about this is exactly backwards. Most financial advisors will tell you that precious metals are a hedge, a small allocation, maybe 5% of your portfolio for insurance. But here's what they're not telling you. During the 2 previous multi-year streaks, the investors who treated metals as a 5% hedge captured a fraction of the move. The ones who recognized the pattern and adjusted their allocation captured generational returns. The macro trends Dow to silver ratio, which tracks how many ounces of silver it takes to buy the Dow Jones, shows a pattern so clean it almost looks engineered. When that ratio peaks and begins to fall, it signals a multi-year rotation from equities into metals. That ratio peaked in 2023. It has been falling ever since. The scoreboard that nobody's watching has been flashing the same result for 3 years. The crowd still hasn't looked up. What I'm about to show you next is the part that took me years of reading supply reports and central bank filings to piece together. Everything before this was context. Now we get to the substance. The first force driving this cycle has nothing to do with investor sentiment or speculation. It's physics. The Silver Institute's Global Supply and Demand reports from 2021 through 2026 show something that should be impossible in a functioning market. Silver has been in a physical supply deficit for 6 consecutive years. The world consumes more silver than it mines, every single year, and the gap isn't closing. It's widening. In 2025 alone, the deficit exceeded 150 million ounces. That's not a rounding error. That's a structural shortage. Silver isn't just a precious metal, it's an industrial metal. It goes into solar panels, electric vehicles, 5G infrastructure, semiconductors, and medical devices. Demand from the energy transition alone is growing at double-digit percentages annually. Meanwhile, there hasn't been a major new silver mine discovery in over a decade, and existing mines are producing lower grade ore. So you have rising demand colliding with flat to declining supply, and the deficit compounds every single year. Let me put that in concrete terms. If you had a business where you sold more product than you produced for 6 straight years, eventually the warehouse runs empty. That's where the silver market is heading. Above ground inventories at the major exchanges have been declining steadily, and the rate of decline accelerated in 2025. This is the structural foundation beneath the price move. It's not hype, it's arithmetic. The second force is what central banks are doing, and this one is about gold, but it matters for silver too because the two metals move in tandem during these cycles. According to the World Gold Council's full year 2025 demand trends report, central banks purchase gold at rates double the pre-2022 decade average. That's not a one-year anomaly. This has been sustained for 3 consecutive years. China, India, Turkey, Poland, Singapore. These countries aren't buying gold because they think it's pretty. They're diversifying away from US dollar reserves. When central banks buy gold at this pace, it does 2 things. It puts a structural floor under the gold price, and it signals to the entire market that the institutions with the most information and the longest time horizons are making a deliberate bet against fiat currency stability. Silver follows gold in every major precious metal cycle. Always has. The gold move legitimizes the trade, and then silver's smaller market and industrial demand dynamics create a leverage effect that amplifies the returns. Now, I know what you're thinking. You've heard this before. Precious metals bulls have been saying this time is different for decades. Fair point. But here's the third force, and this one is pure math that nobody can argue with. US national debt has reached $38.5 trillion. Annual interest payments on that debt now exceed $1 trillion per year. Let that settle in your mind for a moment. The United States government is paying more in interest on its debt than it spends on national defense. This is the same macro environment, the same debt trajectory that preceded every major precious metals outperformance cycle in modern history. In the 1970s, it was the combination of rising debt, loose monetary policy, and a loss of confidence in the dollar that fueled the metals run. After 2008, it was quantitative easing, zero interest rates, and exploding federal deficits. Today, you have all 3 ingredients simultaneously, and at larger scale than either prior cycle. If you stayed with me this far, you understand more about this cycle than most financial advisors. But the next section is what separates pattern recognition from guessing. Stay with me. Because here's the thing, none of what I just told you matters if the streak is about to end, and every streak in history has ended. So instead of asking why metals are winning, the smarter question is this: what has historically ended these streaks? There are only 3 forces that have ever done it. Force number 1, a sharp Federal Reserve tightening cycle. In 1980, Paul Volcker raised the federal funds rate to 20%. 20%. That crushed inflation, crushed commodity prices, and ended the 1970s precious metals supercycle overnight. The question today is whether the Fed is anywhere close to that kind of aggressive tightening. The answer is no. The Fed has been cutting rates, not raising them. Inflation remains above target but is nowhere near the double-digit levels that triggered Volcker's response. For this streak ender to activate, you would need a dramatic policy reversal that no one at the Fed is even hinting at. Force number 2, a resolution of the geopolitical tensions driving safe haven demand. Gold and silver benefit when the world feels unstable. If the wars in Eastern Europe and the Middle East suddenly resolved, if US-China relations normalized, if the de-dollarization trend reversed, you'd see safe haven flows dry up. Is that happening? You can answer that yourself by reading any newspaper from the last 30 days. Geopolitical tension isn't easing. It's intensifying. New tariff regimes, export bans on critical minerals, military buildups across 3 continents. This streak ender isn't just absent, it's moving in the opposite direction. Force number 3, and this is the one that's closer than you think, but not the one most people would guess, a collapse in industrial demand. Remember, silver's dual identity as both precious and industrial metal is what gives it that leverage over gold. If we entered a severe global recession, industrial demand for silver would fall off a cliff. Solar panel installations slow down. Electric vehicle production contracts. Semiconductor fabrication pulls back. This is the scenario where silver could underperform gold and potentially break the streak. The double-line portfolio management report from January 2026 specifically flags this risk. If global manufacturing rolls over hard, the industrial demand component of silver gets hit even as the monetary demand stays strong. So the honest assessment is this: two of the three historical streak enders are nowhere in sight. The third, an industrial demand collapse from recession, is a real but not yet imminent risk. It's the crack in the wall that you need to watch. Now let me tie all of this together with the part that matters most, and it's not about silver. It's about your brain. The real magic happens in how you process information. Because here's a hard truth that might sting a little. If silver has beaten the S&P 500 for 3 consecutive years and you still hold zero precious metals, the obstacle isn't information. The obstacle is psychology. There's a concept in behavioral finance called familiarity bias. You invest in what you know. You know stocks. You have a brokerage account. You own index funds or maybe some individual names. When someone says buy silver, your brain doesn't process it the same way as buy Apple. Silver feels foreign, it feels fringe, even when the performance data screams otherwise. On top of that, there's recency bias. For the decade between 2012 and 2022, stocks crushed metals. Your brain anchored to that decade. It told you that equities always win and metals are for survivalists. But that decade was the anomaly, not the norm. If you zoom out to 50 years, the data shows clear multi-year cycles where metals dominate equities. We happen to be in one right now. Then there's portfolio inertia, which is the most dangerous one. This is the tendency to do nothing even when evidence suggests you should rebalance. It's not laziness. It's a deeply human response to uncertainty. Making a change means admitting your current allocation might be suboptimal, and your ego doesn't want to do that. So you stay in 100% equities while silver compounds at 3-digit returns, and you tell yourself you'll look into it next quarter. This is the part where most people check out. Don't be most people. The pattern in the data is not subtle. 3 years. Consecutive outperformance. A 6-year supply deficit. Central banks buying at historic rates. Sovereign debt at levels that have preceded every prior metal supercycle. Your portfolio either reflects this reality or it doesn't. We're in the home stretch now. And I've saved the most important part for the end. How all of these pieces connect into a single framework you can actually use. Let me bring this full circle. The 1970s cycle ran for roughly a decade. The post-2008 cycle ran for about 3 years from trough to peak. Both cycles shared 3 structural characteristics: rising sovereign debt, accommodative monetary policy, and a physical supply imbalance in the metals market. All 3 characteristics are present today, and by several measures, at greater intensity than either prior cycle. The scoreboard I mentioned at the beginning, the one nobody's watching, isn't just showing a score. It's showing a pattern that has appeared twice before and both times preceded the most explosive phase of the cycle, not the end of it. So here's the practical question, and it's the one I promised to address. If you hold 0 precious metals and 100% equities, the 3-year data doesn't tell you to panic. It tells you to ask yourself a question: what would my portfolio look like if this pattern continues for another 2 to 3 years, and what would it look like if I had rebalanced even modestly? You don't need to go all in on silver, but the data suggests that ignoring the longest-running equity underperformance streak in decades carries its own risk. The risk of sitting in the stadium, staring at your phone, while the scoreboard flashes a result that could define this decade of investing. You're no longer watching a scoreboard that nobody's paying attention to. You've seen the data. You've seen the historical map. You've seen the 3 things that end the streak, and you can evaluate for yourself whether they're present. The question isn't whether you have the information. You do now. The question is what you do with it. 10 years from now, you'll either look back at this period as the one where you recognized a generational pattern unfolding in real time, or you'll look back and wonder why you didn't act on what the data was telling you for 3 straight years. Silver, gold, the Fed, the debt spiral. What's the next topic you want me to dig into? Drop it in the comments. And if you know someone who's 100% in equities and has never looked at this data, send them this video. Because the scoreboard is still flashing. The question is whether anyone in their life is going to tell them to look up.